Cement makers in Nigeria recorded weak volumes in the first half of this year, impacted by energy constraints, nationwide cash shortage, and weak capital expenditure. Analysts at Vetiva maintain a cautious outlook regarding strong cement demand from the public sector in the second half of this year. Abigail Alabi, industrial goods analyst for Sub-Saharan Africa at Vetiva, joins me now for this discussion. Thank you so much, Abigail. Pleasure to have you on the show today.
Thank you for having me. Good afternoon.
Well, the cement makers did have a rough time in 2022. We saw volumes strained there, and even into first quarter of this year. Could you shed more light about it? Talk to us what are some of the key major challenges?
Okay, for Q1, we saw the cash shortage affect most cement producers like Dangote Cement and Lafarge. And we also saw weak capex distribution as a result of election uncertainties as well. So both of these contributed to decline in volumes for cement producers. So for Lafarge, we saw a 13.9% decline in volumes for Q1. And for Dangote Cement, we saw a 13.5% decline in volumes for Q1 as well. So those factors contributed, caused a decline in cement volumes for those companies.
Now, going forward for these cement producers, looking into your notes, you did highlight persistently high input costs. How do you see them navigating this going forward into the year?
Okay, so the largest contribution of input costs for cement companies also is energy cost. And as a result, you've seen the likes of Dangote Cement and also Lafarge switch to alternative fuels like biomass, which is considerably cheaper than fossil fuels as well, to also use for cement production. We've also seen them adopt a multi-fuel system, so like a combination of gas and coal for cement production. And also for distribution as well, we've also seen them switch from diesel trucks to also CNG, that's compressed natural gas, which is cheaper than diesel as well for cement distribution. So we expect to see the effect of this in their profitability margins for this first half of the year when they release their first half of the year results. And we also see that this is going to continue, and we also expect to see this to also boost their full year margins as well, so full year profitability.
That was going to lead me to my next question, which you've talked partly about, looking deeper into earnings forecasts. And just the general operating environment. Now they've been able to somewhat solve the energy challenge for the likes of especially Dangote and Lafarge. But in terms of expansion plans, I know obviously Dangote Cement footprints across the African continent, but I mean, how big are you expecting the company to go in terms of footprints and perhaps, what else we can expect?
So Dangote Cement just recently launched or just recently opened a cement plant in Ogun State, and that is just going to add, that's going to add to the total production capacity. However, we're expecting to see this also increase, expecting to see both cement companies, Lafarge and Dangote Cement, also expand their footprint outside Nigeria, because there are a lot of underserved countries in Nigeria and other parts of Africa. There are countries that do not even have limestone deposits, and they do not have any choice than to import cement. So we're expecting to see Dangote Cement and other cement companies as well expand their reach into those countries. And based on cement consumption for Sub-Saharan Africa, we are at 140, and that's way lower than what the world average is saying. So there's a huge market for cement producers in Nigeria to expand into other markets as well. And also, we're also seeing a rapid increase in population in Africa, and that will cause an increase in the demand for infrastructure like housing, building, and also commercial and residential infrastructure. So all of this combined just gives a huge opportunity for the cement players in Nigeria to play. There's a huge market for cement players to play, and there's a huge market in Africa as well based on these factors: increased population and also low cement consumption right now. So based on this, we expect to see a huge market, or we expect to see growth opportunities in this market.
I imagine investors at the NGX also will be taking position, keeping this in mind, while of course having the stock in their portfolio. Let's talk about other industrials, the likes of Julius Berger, for instance. Talk to us about this company. What is your outlook? How do you feel about this company in terms of what they're doing, earnings outlook, etc.?
Okay, so for Q1 as well, Julius Berger was also affected by the cash crunch and also the uncertainties relating to election that also slowed down capital expenditure. However, for the second half of this year, we expect that the real estate activity or real estate sector would sustain demand for, or sustain revenue for Julius Berger. However, we also expect that the federal government to also resume the capital projects that was being done by the previous administration. So of that combined, we expect to see that one would drive growth for Julius Berger. However, we are still going to see them grapple with cost lines or increased cost lines, high inflationary pressures, and also FX issues have also been one of the pain points for Julius Berger. And that has also caused an increase in building materials as well. So until they are able to minimize costs, we'll most likely see that affect their margins. But nonetheless, you still expect Julius Berger to do really well for the second half of the year.
Now, for the longest time, for many of these companies like Julius Berger, it was FX scarcity, and of course multiple exchange rates. But apart from the fact that we had multiple exchange rates, the issue was the scarcity of the dollar. But now that we have that in the naira float, and we sort of have some kind of a price discovery for the naira, what does that change anything around the FX issues for the company?
Okay, so it depends on how they have also how they've been sourcing their FX. So for most companies, they always source their FX through the blended means, either getting from the official market and also from the parallel market, or they either get from either one or combine both of them together. However, depending on how Julius Berger has always sourced for their FX for importation of building materials, I also think that this unification of exchange rates also being a way to help them with their FX issues. They will no longer have to go through or they will no longer have to endure the large spread between the official rate and also the parallel market exchange rate as well. So I think this also bodes well for them in the long run too.
Okay, let's expand this conversation a little bit, looking at the broader sub-Saharan African region. Still going back to the cement makers, Kenya, Angola, Ghana, and South Africa. Talk to us about the players. What are the key themes that you're watching for these countries?
Okay, first for Kenya, they also had an election year, and that election year caused a decline in cement consumption as well, because they also had uncertainties about the election. Also was a heightened political climate, and we most likely saw the previous administration stop their capital projects, waiting for the onboarding of a new one. However, since we have seen a calm political climate in Kenya, we have seen the new administration resume the capital projects being done by the previous administration. We've also seen them focus on, or we've also seen them also create new public-private partnership as well, to also encourage private investors to also come to bridge the infrastructure gap. However, they're also seeing the new administration as well, also establishing or constructing new motorways as well, and that has also that would also contribute to increased cement consumption for the rest of the year.
So capitals more an increase in capital spend. Okay.
Yes, an increase in capital spend. And for the likes of South Africa, South Africa has been grappling with the aftermath of COVID-19 effects since 2020. And in 2020, we saw a contraction in their GDP. And also that also hit the construction sector as well. And even though we have seen a recovery in GDP for South Africa, the construction sector is still slowed down. We're also seeing slowdown in growth in construction sector. And this is due to the fact that they do not have sufficient funds to be able to continue the projects that has been started by the South African government. And that also caused the cancellation of so many projects as well. And they're also going through an energy crisis in South Africa. And I believe that according to South African agencies, 2023 is going to be the worst year for them, with about days of 250 days of power cut. And that will also affect construction activities and also cause an increase in operational costs for cement producers as well. So we'll most likely see construction sector in South Africa also struggle with power issues, and also it will also affect operations for them.
What about Angola?
Angola has had a very, very incredible year, since we have seen a resurgence in demand for oil and also oil prices, and that also increased oil revenues for Angola. And as a result, we saw the federal government of Angola also, in turn, increase public investments, trying to bridge the infrastructure gap. We've also seen them establish development plans as well that spans up to 2027. They're also planning to bridge the infrastructure gap and also reduce foreign dependence on importation, and also increase domestic production as well. So Angola has had a pretty impressive year, and we expect that to also continue for the second half of this year as well.
Now, for the stock, let's talk about those listed on the. Let's talk about Nigeria. Lafarge, Dangote Cement listed on the NGX. Talking about the stock. Dividend yield, valuation, how investors feel about these stocks, especially. But let's talk about, we know, I suppose the picture is clear with Dangote Cement, but for Lafarge, how do investors feel about the stock in terms of, the fundamentals and, going forward?
Lafarge is a pretty fundamentally strong stock. Over the last few years, we have seen them deliver their balance sheet. So at a point they were not at a loss because they had a loss-making company in their portfolio. However, since they have been able to deliver their balance sheet and also deal with their foreign denomination loans, Lafarge has been delivering strong results as well. And also they're also undergoing a debottlenecking process in their Iwe Corona Shaka plant that also intends to free up capacity for them and also additionally create 2 million metric tons to their capacity as well. And one thing that Lafarge is also doing really well is their cost efficiency. For their Q1 result, they were able to reduce their cost of sales by 6%, and this is due to the fact that they were intentional about reducing energy costs by using alternative fuels through their subsidiary called Geocycle. So they have also used biomass to also contribute or to also minimize the impact of energy or input costs and also inflation and also FX issues on their energy cost, and also were able to show up their margins as well through that. And they also started also using CNG trucks for distribution. They have switched from more expensive diesel to CNG, and also we are very, very optimistic about Lafarge cost optimization strategies for the second half of the year, and that will also contribute to impressive bottom line growth and also profitability margins for them throughout the rest of the year.
So buy, hold, sell?
It's a buy for us.
Okay, Dangote Cement. I mean, I didn't want to go there, but let's
Dangote Cement is also a buy from us.
It's also a buy. Julius Berger?
Julius Berger is also a buy.
So what are the industrials? I mean, looking across the board, the industrials, I know it's also and the index has done well this year, and I mean, it's been quite a surprise, even the year-to-date return, especially the banking sector. But in terms of, for the other industrials, so what are you forecasting for them in terms of how they navigate the environment and also return, year-to-date return for investors?
Okay, so like we said, this pro-growth policy that we have also seen, we've also seen this affect the equities market. So I believe that these pro-growth policies that has been announced, like the removal of subsidy and also unification of the exchange rate, that will also cause that will cause an inflow of investment into the equities market. So most likely see bullish trend in other industrial goods companies as well.
All right, thank you so much, Abigail, for talking to us. Appreciate your time on the show today.
Thank you for having me.
Abigail Alabi, industrial goods analyst for Sub-Saharan Africa at Vetiva.